this is the third year of the expansion with a very aggressive monetary policy. And of course, that happens by creating money and credit, and which creates debt. If we take it chronologically, I think there's the short-term cycle, which is usually the business cycle, takes 7 years on average, and give or take, depending on where you start the cycle, give or take a few years. I think we're moving along here quicker. So we're now going to be in a very tight environment, and that changes everything. So when we look at the returns of equities, and we look at the well-being of companies, you see that the cost of interest relative to the expected returns of equities creates a squeeze on equities, changes the economics. A lot of borrowing has been done at much lower interest rates and so on. The return on equity for a company and versus the cost of debt is changing, and all of those things are changing. And like all bubbles or paradigm shifts, the mentality that did exist, we don't have to worry about inflation, cash is a safe place, and so on, gets a shock. There's a punch in the face. There's been a 40-year bull market, and there's a punch in the face to all investors. We're going through it as Jeremy describes. And when that happens, things that were never supposed to happen, because everybody believes in the tech companies, and that which is the same as the Nifty 50 or the .com companies, they get hammered, right? So like you say, 75% decline in Cathie Wood's funds, and so on and so forth. That causes the adaptation. So we're in the beginning of that adaptation. That is most similar, I think, to the 1970s period. It becomes financial. So I think we'll come to the 2022 elections, and that'll have economics and markets has a big impact. So we'll be in the 2022 elections. I think that you'll see greater political extremism coming out of that. Moderates are leaving, and even those who are running are populists. Populists are people who will fight to win and will not accept losing, and will fight for their constituency. So you'll see more populism of the left and more populism of the right. So if I look at 2023, I look at 2024, and I'm worried about the neither side accepting losing. And I think that there's a big risk that that the system is in jeopardy, because history has shown when the causes that people are behind are of greater importance to them than the system is in jeopardy. Those types of things change the world landscape. I'm emphasizing the United States, and certainly Europe is in that type of a position. So I think that when I look at it, it'll be very important to not only diversify well, but to be able to be long and short different assets in order to perform well in that environment. My main things are, first, cash is trash, and bonds and debt. It's not going to be good. Either avoid those or position yourselves so that when those things operate, and position yourself for inflation. So there are lots of investments pertaining to inflation. I agree with Jeremy's comments about commodities, and the big commodity cycles are reactive. There's a giant, just like the 40-year bull market in bonds, associates with a commodity cycle where everybody adapts to that. Companies don't hedge, inventories are drawn down. There's less investment in those things. When that switches to that kind of an environment. And the big overarching thing is that the amount of financial claims that exist, and there's charts in my that I repeatedly show when I deal with the changing world order. What is the amount of financial claims, assets, relative to real assets? And you could see that through history, when those financial claims, it's like a bank has too many IOUs on its real money. Then you always get into these environments where it's undesirable to own the debt and you have negative real returns. And so to position one's portfolio in a tilt that way. But of course, the way that we do it is to separate alpha and beta, right? So 2 parts, core. How do you create a truly well-balanced core portfolio? And we know that the typical well portfolio is not well balanced, with its greatest vulnerability being in that upper right quadrant in our box, which is the inflation box. And we know that we're in that environment. So from a starting point of view, I would encourage all investors to look at that box, those 4 quadrant box, that box that we have: rising inflation, falling inflation, rising real growth relative to discounted, falling real growth relative to discounted, and see what the biases are in those portfolios. I believe that now you can simultaneously reduce risk and raise returns, reduce risk of that portfolio by having more in that upper right quadrant, rising inflation, and you will reduce your risk, because if you look at your portfolio, typical investor's portfolio, that is the environment that it is missing. So you start with that. How do you get more neutral? How do you get better balanced? And you cover yourself from that exposure. And then you make your tactical moves around it. And the tactical moves, again, should not be in those debts. It should be very well diversified. I think that the social and political conflicts are going to be a big investment thing coming forward. And so that'll mean, and the way I look at it is, I want to look at places that have good income statements and balance sheets. So when I say places, I mean countries, as well as individuals that make up those countries, the individual people and the individual companies. So do they have a good income statement, financial stability? Do they have a good balance sheet so that they can weather those things? And also, it's a sign of their productivity. Are they productive? And then number 2, are they civil with each other? I really do believe that internal conflict and bad finances are going to be defining characteristics of where to invest or even where to be. And then if I carry that forward to the third, am I going to have risk of being in a international war, an important international war? So I want, when I'm picking those locations, I want to be out of those debt instruments, largely minimized on the financials, the inflation hedge assets, well diversified. Look to parts of the world that are not as plagued with this. So emerging Asia is very interesting. India is interesting. So diversify. Look at neutral countries during that period of time. Watch out for government controls on capital markets, because that's the logical next step. History has shown that. Watch out for foreign exchange controls, could be. Watch out for those things. So those are the themes that I think are most important and will be most important in investing.